Welcome to the Steadyhand Fund Update. I'm Tom Bradley, Chair and Chief Investment Officer at Steadyhand Investment Funds. Today we're going to review the equity fund, and to help me do that I've got Gord O'Reilly from Fiera Capital, the manager of the fund.
Thanks for having me.
Now Gord, the last time we did this, the equity fund manager was called CGOV. It's now Fiera Capital. What's changed as you are now part of Fiera?
Well, the best part of it is nothing really has changed. I actually moved from Midtown Toronto to downtown Toronto and the second floor to the sixth floor. But other than that, change in location, our team is doing exactly the same thing that we've always done, trying to find great companies for the Steadyhand portfolio and manage it to the best of our ability. I mean, but joking aside, there's a few things. Our trading is now done by a professional team in Montreal, whereas I used to do my own trading. And we've got better sort of risk management and better compliance. And at CGOV, I used to worry about partly running the CGOV business. Now I'm just solely focused on running our portfolios. So all in all, it's been a fantastic change, and it's been great joining Fiera.
So now, under both nameplates, Gord, you've managed this fund since inception. It's had an exceptional record. Now let's maybe look a little more specifically at 2019. It was a good year. What kind of drove returns in 2019?
Well, 2019 was a year of multiple expansion. If you and I had talked at the beginning of 2019, I would have told you I was expecting the S&P 500 earnings to sort of flatline and potentially even be negative, and I would have been right. Whereas I was somewhat cautious on the market actually did really, really well, being up close to 30% in the US and over 20% in Canada. So it was all about multiple expansion last year, and fortunately, because of reasonably good stock picking, our companies benefited from that tailwind. But it was certainly some of the Shopifys and things like that did much better than I would have anticipated.
Some years there's not a lot of changes of names in the portfolio. You guys are good, dedicated, long-term investors. But last year, you and the team were more active. More buys, more sells, some new names. Maybe explain why that was.
Our sense is that with the change in the Federal Reserve, now that they're actively trying to inflate the economy through massive purchase of treasury bills, and basically you're monetizing the U.S. federal debt, you're wanting to get exposure to potentially some faster growing businesses. And we see, in case we added Microsoft, there's a digital transformation going on in the world, and only about 40% of businesses have a digital transformation plan in progress. And Microsoft, with its hybrid cloud strategy, where you're able to have your on-premise cloud and off-premise cloud, Microsoft serves that market exceptionally well, and we think that market can grow for the next 10 years. We also like the fact that Microsoft has net cash on its balance sheet, no debt. So it's in an enviable position to benefit from this digital transformation. So you're taking out something like a Payson, which is a company we've loved for a long time, but it's dependent upon drilling days in the oil patch, and seemingly there's lots of oil around, and the macro economy is not suggesting that we're going to have a huge uptick in oil consumption in the near future. So we decided to part ways with something like a Payson and add Microsoft, and just increasing the sort of torque to the new digital economy rather than sort of the old economy. Not to say that we've lost our fundamental footprint and valuations, but we still like the businesses of a Microsoft.
There's some other new names. Maybe we can talk about S&P Global.
Sure. I mean, S&P Global is a truly wonderful business. If you've heard of Moody's, S&P has a bond rating agency similar to Moody's. It has a data intelligence business similar to a Bloomberg, and it has a index business similar to an MSCI Global, which you've got three truly awesome businesses in one in S&P Global. It has over 50% operating margins, and it's all highly profitable, recurring revenue type businesses. Even their S&P Platts division, which is only about 13% of revenue, they have the license on the Brent contract for oil. So you get a little bit of a play on commodities. I mentioned earlier that we'd sold out Payson, but through a small portion of the S&P Global, we're still getting exposure to oil and LNG and other commodities. So we like that type of business as well. And also, I'm sure a lot of your investors have heard about the sort of push towards environmental and social and governance factors becoming more and more prevalent, and ESG for S&P Global is becoming a bigger and bigger source of potential revenue in both the rating side and the data intelligence. And we've actually, our group has been sort of trying to beta test some of the new offerings from S&P Global, so we're quite interested in it as well. The other interesting thing is S&P Global became the first bond rating agency to be licensed to rate issues in China, which is a huge potential market. It's still very, very small right now, but we think it's another avenue of growth. And as I say, finding more and more of those businesses that have huge high operating margins is very sticky businesses, very resilient businesses. We tend to like those.
Gord, it's been a great run. We've just talked about 2019. Is it getting tougher to find opportunities out there?
We're finding it really, really tough to find what I would call good value in the markets. I saw a chart from Bloomberg the other day that the number of sectors that are at extreme valuations is the highest it's been basically ever. Price to sales ratios are the highest since the internet bubble in early 2000. So, to us, it's a time to proceed with caution. The only sort of two sectors that are sort of a little bit out of favor are energy and to some extent healthcare in terms of relative valuations. We think that the Federal Reserve in the United States is going to, slowly want to inflate the economy because that's their only way out of some of the debt troubles that we're in. And that eventually is going to lead to a rebound in some of the energy names. But we think before we get to that point that energy names really, really excel, we think that there's going to probably be another slowdown a bit in the economy, and then they will have to resort to some fiscal stimulus. But we have some energy names on the watch list that we'd like to buy because they're all really cheap, and we've got one in particular that's a truly fabulous business that we'd like to own. And there's some other areas that we're looking at in the consumer discretionary area. That, as I say, we've been doing our homework and waiting for the right valuations. But it's, as you referenced, I worry a lot. And, the valuations for some of these businesses, are way beyond what you and I did when we were looking at, 10 or 12 PEs. The stocks that trade at 10 or 12 PEs now are almost going out of business. So, we think there's going to be a reversion to value at some point, but we're also, by having some of the Microsofts in the portfolio and having some of those, names that are benefiting from a growth type environment, we're trying to barbell some of the more value names in the portfolio with the growth to enable the Steadyhand client to get through, hopefully with a good return, but minimize our risk as we've always tried to do.
And Gord, the healthcare sector is an area where you're finding some pretty interesting companies. Last year it was Philips. More recently you bought Danaher. What's the thesis on that purchase?
Danaher is another truly wonderful business. It's got about 70% recurring revenue from its installed base of healthcare equipment, which, to us in this type of environment, we really, really love the recurring revenue model. The other interesting thing about Danaher is it used to be considered a sort of an industrial conglomerate, but it's now morphed into a healthcare conglomerate. And the interesting thing that sort of got us excited is we'd been following the GE healthcare business. They had a great biopharma unit that we liked. We never liked GE, but we liked their biopharma. And as you may recall, GE was close to bankruptcy at one point last year. And so Danaher was able to buy the GE biopharma unit out of GE. And it was, they didn't get it as a steal price, but they paid a fair price as opposed to if GE had been in a lot better strength position to negotiate. So as I say, they got that acquisition, and we think it's sort of solidified their growth for the next 5 or 6 years at high to mid-single digits with great recurring revenue, lots of diversity. And as you know, we're very big proponents of ESG and impact investing. And we think with Danaher's water business and with their biopharma business, they're helping the world economy in a truly impactful way. So we really like the Danaher business.
Well, Gord, I think that's a good place to end, and I will leave it there. thank you for doing this. I know you'd much rather be researching stocks than talking to me here on video, but also want to thank you for watching. And if there's any questions that come out of this video with Gord O'Reilly, feel free to give us a call and we'll try and answer them. Thank you.